What does New Year's 2024 bring to you? Stay tuned. Welcome to this week's edition of NoteSchool TV. Yes, this is our final edition for 2023. And, we're going to be ringing in the New Year's here in a few days. So Eddie and I have we have a great presentation for you today. What we think is, not really what we think, what we have researched and see what's on the horizon for 2024. So a couple of things. Number one, make sure and like what you see today. Yep, go ahead and hit that like button. If you haven't subscribed to NoteSchool TV's channel, make sure and go ahead and do that. And lastly, go ahead and hit that bell notification. Boom. So that you will, you'll know when we go live every Wednesday at 11:05 Central Time. Don't forget to send your comments, guys. Eddie and I love to hear from you. Share with us what's going on in your market. Any questions you have, make sure and share those with us. And we would love to have you become involved with NoteSchool in 2024. So simply go to noteschool.com/TV. Again, noteschool.com/TV. Well, let's bring on, for the last episode of the year, our monthly/yearly update. NoteSchool's founder, NoteSchool's chief visionary officer, all-around good guy, my friend, Mr. Eddie Speed.
Good morning, Joe.
How are you?
Man, it is going to be quite a year ahead of us.
You know, and this year it's been an interesting year, and it has gone by in a flash, man.
Yeah, it has. I want to tell the audience something. Joe has done more research and more preparation for this year end. Where are we? Market update than any episode this year. And if you've paid attention to these episodes, there's a lot of work that's gone into every one of them. But Joe has done a lot of work. Several of us have tried to contribute some things that he's helped us scrub through. But Joe, thank you for this. I think this market update is going to be very meaningful to us. I had a conversation about a week ago with a guy a long friend of mine that runs a hedge fund, right? Yes. And they have mega billions, north of 50 billion under management.
Wow.
And so not just a little bitty, shop, right?
Yeah.
And his parting words to me were, Eddie, for the note space, 2024 is going to be it's going to be earth shattering. Yeah. It's going to be very, very big. And I said, yeah, I know, I'm feeling it. He said, no, I'm telling you, it's going to happen. And so I think as we enter this market, the reason we put so much emphasis on market updates, guys, you don't know if you don't know the weather report, you don't know how to dress.
That's right.
You don't know how to prepare for the storm. You don't know how to figure out whether there's going to be a drought or a hurricane, right? And so this market data we're giving you guys is tying in together with why we're predicting the opportunity that we're predicting. Notice what I said, predicting the opportunity. Yeah. Without knowledge of the market, an opportunity passes us before we even knew it was in front of us.
Yeah.
Joe, let's do it.
And Eddie, the momentum, really the entire last quarter, right? October, November, December, but really the momentum that has been in our business, in NoteSchool, and in our sister company, Colonial Funding Group, since Note Expo, it has been phenomenal. So I just wanted to share that with everybody, and thank you for coming to Note Expo and participating. And so, yeah,
we had a record-breaking class in December, record-breaking in 20 plus years of training. So I'm just saying to you that I think part of it is people are. It's not just us telling you that, you're feeling it. We're trying to give you specificity to why you're feeling what you're feeling. or sometimes we're not quite sure of all the symptoms. I think these market updates are defining the symptoms that we're feeling. We just don't necessarily know why we're feeling it. So let's look through it, Joe.
All right. Well, we've got the market update. So we're going to first talk, Eddie, about the housing market and what's going on there.
Yep.
So let's get into it. So the Business Insider, these were just home price predictions for 2024. So, and it says, right, the experts, right, generally expect home prices to increase in 2024. Well, Fannie Mae, Eddie, they're saying 2.8% by year's end. Year into 2024. MBA, mortgage bankers, are saying 4.1. NAR, National Association of Realtors, they're a little more conservative, and they're saying just a little less than 1%. And Realtor.com, well, they're saying a 1.7% fall. So interesting stats.
I can tell you that the big Wall Street money is betting on a flat market.
Yeah.
I can say that with 1,000% confidence.
Yeah.
And nobody's predicting a gigantic increase. The biggest, of course, is mortgage bankers. And I think that's a little bit ha-ha, to be honest with you.
I think we're somewhere between that one, Eddie, and the bot and the Realtor.com. I think we're, yeah.
Well, that's where everybody's shooting, is somewhere, we flat to, even, up and down, that kind of thing. And here's the good news, those guys. We're not wanting the market to go down. We're going to have the biggest year buying non-performing notes in 2024, possibly we've ever had in my lifetime.
Yeah.
So understand, if the market's flat, then it's a lot easier to predict what the collateral is worth in the future than it going like that I've seen it done in 2008 and 1986 and other markets. So this is good news for us, just like it is for you guys, right? Yep. We're not wanting a crash.
So Market Watch, Eddie, builder confidence index rises for the first time in 5 months. And I love that, Eddie, you and I have talked about this, about rates falling. And actually, they've literally fallen about 25 basis points, right? So like 1/4%.
Well, Joe, the headlines, always tell the story, right?
Yeah. Well, the National Association of Home Builders, they're saying, well, we've passed the peak for mortgage rates for this cycle. But it went up a bit from it was somewhere in the low 20s. So it went up 3 points to 37. Builders kept up sales incentives. Look at that. 36% were price cuts.
Well,
and then,
let me tell you what else, Bill. The incentives is they're not necessarily lowering the price as much as they're actually doing rate buy downs.
Yes, there you go.
That's the pattern. And so, and the builders, we talked about this in September. The U.S. Census Bureau said there was a 7.8 month supply of houses. So there was a lot of building that got cut off. And so those are the reasons. So we're watching all this. There's a shortage of listings. There's a little bit of an oversupply of home builder houses. We're saying that I think that's what's forcing us into a flat market.
Absolutely. And just real quick, Eddie, just tell everybody what, when you're talking about buying down the rate, just give everybody the 30-second big view on that.
So let's just say that I needed a $400,000 mortgage to go buy a brand new house, and interest rates were, just call it 7%.
Right.
The home builder comes in and tells the mortgage company, I want my customer to have a 6.25% interest rate.
Right.
Not 7%. What do I have to pay you, Mr. Mortgage Lender, up front in order to give that at a below market rate? Mm-hmm. And the lender says, well, Eddie, you'd have to go pay 4 points, 3 points. Mm-hmm. So I'd have to pay 3% on a $400,000 mortgage to drop the rate down to a lower than what the stated rate normally is. It's called a buy down.
Right. And a point is 1% of the loan, basically.
1%. In the mortgage banking world, they call it 100 bips.
100 bips, basis points.
100 basis points. Yep.
All right. So NAR's also identified the 10 real estate markets with the most pent up housing demand, right? They're going to outperform. So look at number one, Eddie.
No shocker. Austin, Texas has still got a black eye. My hometown of Dallas, Fort Worth, there's Dayton and Dayton, Ohio, the Chapel Hill area.
Yeah, that's that Raleigh-Durham area. Our friend Tim Siebelink calls that the great state of Raleigh.
Yeah, no kidding.
Nashville is blowing up. We've got our good buddy Seth. He and his family moved to Nashville. I know 3 families from Okeechobee that have moved to Nashville in the last 3 months. So, yep.
So, not surprising. I think Philly is a little bit of a surprise.
It is, isn't it? Yeah.
Portland is quite a surprise because there was a big exodus out of Portland. So maybe, yeah, I don't know.
Well, then that's Portland, Maine, not Portland, Oregon.
Oh, of course. Yeah, I got that. Yeah. Okay. And then the DC area, of course. And so, yeah, that's good. That's good information right there. Austin has experienced a pretty big dip. So it'll be interesting to see how it flattens out a little bit.
How that reads going forward. Yep. So this is from Axios, and it's America's housing supplies explained in one chart. So you can see, Eddie, this is back during the boom, right?
2008, or 2006.
Yep, 2006 and 2007, early 2007. There were about 2.5 million or so excess homes, and then it peaked down here, and that would have been about 2021.
Yeah.
And now we're at a negative 3.2 million homes. Home builders are, there is a pent up demand for homes. So we'll see how that plays out.
Yeah, Joe, I'm going to tell you this. I don't believe this. I mean, that means that basically everybody in America had to go out and they all needed 4 more houses in the same. Right. Every household split into 4 more.
Right.
And I'm just saying to you that the reason we have a shortage is because there's a shortage of listings.
Yeah.
So this is a very contrarian position. I'm going to tell you that. I do not believe that we're 3 million houses short. There's no matching data that really proves why that's true.
Yeah.
So
I thought that would be a very contrarian thing to put there. But yeah, I do believe that we had, back in 07, 06, 07, I think we did have that excess of housing.
No argument. I'm just saying to you that
that's a lot of housing.
Normal inventory of housing is 2 million houses for sale on any given day.
Right.
Now we have 600,000. Well, we have a shortage. Right. But the shortage is because people don't want to go. They don't want to go pay off their 3.5% mortgage and sell their house.
That's right.
Right. And so the fact that we're just saying there's such a deficit of housing, period, I'm just I just am saying to you that while they're the experts, I disagree.
Yeah. Well, good. So, Eddie, we've got from mortgage reports, homeowners, borrowers gained 1.1 trillion in equity, and this is in the third quarter of 2023. Which is a huge number. And you can see the numbers here. California, they're saying they gained $51,000 each, homeowner in California. Look at that, it's a -9 in Texas. So this is kind of an interesting report. 28,000 in Florida.
Well, these are markets that have had some decreases, and they finally have gotten to where they have a little lift back in them.
They do, yeah.
California is had a pretty significant drop in values.
They did. I
had somebody tell me the other day that California was just going up like crazy, talking about for the past year and a half, and I'm like, No.
Yeah.
No, the data doesn't say that at all.
The trees are it's going out of the universe, right? Growing to the moon. Yeah.
I'm glad they're back.
I'm glad they're coming back.
Congratulations, guys. The world's not going to come to an end. You're going to be okay.
You're going to be okay. So let's talk about, you and I have talked about this quite a bit over the last month or so, but so $1.8 billion verdict and this was just in Missouri and on real estate commissions.
Guys, if you've been tracking this story that started with California and now all of a sudden Missouri, which is considered to be not near as liberal as California, I asked somebody at lunch today, I said, how's NAR going to cut the check? I mean, I don't know what NAR's worth, but I don't know that they're worth $10 billion.
Yeah.
So this is like a thing.
You and I both were talking from an agent that's right across from St. Louis yesterday afternoon, and we were talking about this. He manages a Keller Williams agent that managed that 600
people.
Yeah. And he said it's going to take a bit to resolve this, but says while already large, the award could grow to a total of $5 billion, depending on what the judge decides. Short term, nothing changes, but we'll see what happens in the long term. And it's not only Missouri, it's California, it's New York, there's 5 or 6 states that have jumped on this. So we'll see how this pans out over the next few months.
This could be the biggest thing that has affected real estate brokerages in modern times.
Right.
It could be the biggest thing since MLS.
You're absolutely right. Absolutely right.
We're watching it. It is not a pretty picture at the moment.
That's right. So Eddie, let's talk about interest rates. So I bumped this up a little this time, right? From 750, I said, well, let's go up a tick here. And we're still a little over 7% with as the APR.
Yeah, we always quote you the annual percentage rate. We don't quote the note rate because the annual interest rate is the effective rate you pay. And we explained the buy down to you guys a while ago. So that means the seller could go in and pay for part of the cost of the mortgage by getting the lender to reduce the rate because they got upfront money to reduce it.
That's right.
But this is the effective interest rate that loans cost, right?
All right. I was looking last night.
Look at ARMs. What happened? Is that crazy? You're going to pay a higher interest rate for an ARM than you are a fixed rate.
That's it. Yeah. And so when you look and you see a 6.49 rate, for instance, if you'll look at the bottom of that Reg Z at the bottom of that, it'll explain what the APR is, what you're really paying. So,
exactly.
Yep. Okay. So this chart is from Fred, and this is just the movement of the 10-year Treasury and the 30-year Freddie Mac mortgage rate. So Eddie, they followed right along here. The mortgage rates approached and did touch 8% last month, and then Treasuries were up to about 5%. And now you can see the spread there, right? So we're there and we're there based on, and this is as of 12/1.
Yeah, if you think mortgage rates are controlled by the Fed rate, then you look at this 10-year Treasury rate and you're like, oh my God, it's a twin sister. And it is.
Yeah.
So that's what really affects mortgage rates is the 10-year Treasuries, not the Fed rates. And Joe, this is why mortgage rates are not expected to drop at the level that the Fed rate drops the prime rate.
Exactly.
So people have all heard the great news that the Fed chairman says he's going to drop rates, blah, 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 and stuff. All true. But that's why people are not predicting a giant drop in mortgage rates, at least for the first 3 quarters of next year.
That's right. Yep. It's all pointing towards the last quarter of next year. And this, by the way, is post the announcement on the 13th that the Fed was staying the course, right? So, yeah, it's a direct correlation there between the two. So this is market expectations, Eddie. And again, this just kind of mimics what the last slide says. So this is showing on the Fed funds rate about 4% by the end of next year. And again, this is following that announcement. So it just, we're looking at we've got a while to go, just exactly like you said there, Eddie.
Yeah.
Yeah.
So yeah, this is going to be a factor.
Missed one.
All right, so here we go. Notes on the economy and across the market. These are different projections from different experts in the field. This is talking about a recession. This is talking about Fed cutting rates.
Yep. Yeah, so Goldman says there's about a 15% probability of a recession over the next 12 months. And Bloomberg, they say that there's about a 48% probability. Goldman says the first rate cut will be Q3 to Q4, just exactly what we've been saying. Then some 25 basis point cuts until 2026 to land in, I don't know if I believe that 3.3.5, 3.75. Now that's 2026. So we'll see. A lot can happen between now and then.
Yeah.
Yeah. But mortgage rates staying around 6% as by the end of the year. Higher rates, Freddie is saying, tighter financial conditions. Boy, we've been living through that about the folks that, they can't get a loan, right?
Yep.
And then consumer debt is over $1 trillion now. Fannie Mae predicting a mild recession. Mortgage rates declining gradually over the next 2 years. Fannie Mae here. Personal savings falling 3.4%, well below the pre-pandemic rate of 7%. JP Morgan Chase again calling for cuts sometime after the third quarter of 2024. And then JP Morgan is also saying 50-50 chance of a recession there. By the end of 2020.
The smartest money is saying there's going to be a mild recession.
Eddie, I thought this was interesting. Non-bank lenders are overtaking banks, commercial, FDIC banks in mortgage lending. So you can see, you've got the Rockets and you've got, the non-banks are as their share. The blue is the non-banks. And the red, the red is the non-bank originations.
Listen, banks are bailing out of mortgage lending, residential mortgage lending at the highest rate I've seen since 2008, and they're doing it because they're not making a profit.
That's right.
Right. We put a slide in last month that said they're losing over $1,000 a deal. But Joe, they're making it up in volume.
They need a bigger truck. Eddie, do you know what a Henry is?
I don't believe I do.
I didn't know until yesterday. That is a high earner, but not rich yet. Okay.
A Henry.
A Henry. High earners, but not rich at this point, right? So that's your HENRY. And a lot of these folks, they have great, their net worth isn't big, but they have big incomes, and they're opting for these non-traditional mortgages, which we remember these, right?
Yeah.
Interest-only loans. And again, higher end properties who invest their money elsewhere. So yeah. So
a Henry. I'll remember that, Joe.
Yep, HENRY. So, yep, we're back to that. Let's talk about commercial, multifamily, and an investor update here. So, we're still not going to touch that stove, Eddie. It's pretty hot, isn't it?
Well, this time last year, I was attending several real estate masterminds, and I was telling people that in the multifamily space, that it was pretty much inevitable that values were going to drop. And they looked at me like I was on the worst drugs that you've ever seen in your life. That they just looked at me with the most pathetic look, like, I can't believe you'd say such a thing.
I know.
And the answer is, I'm like, guys, the evidence is very clear. And of course, we've seen that now that it's resulted And yes, values have dropped. And the issue is, once again, this is my humble opinion, but I think the data supports it. The drop ain't over.
It's not over. It's still a falling knife, right?
Right. So that is the condition of commercial lending, the condition of banks, but the commercial lending and banks is what is triggering the note inventory to have grown so much. People say, why is that related? Because banks are not filling the gap.
Right.
And when banks don't fill the gap, they more people need to seller finance. And then they can't go take their loans to the bank and pledge their loans against the bank. They're having to sell them in the secondary market. Banks are cleaning up their balance sheet and selling loans. And Joe, we probably have 6 times the amount of loans that we bid in December that we bid in January of this year.
Yes.
That's just a fact.
Yeah, our Colonial is out there pushing the plow every day, man.
By the way, we just won an award for that.
We did. Gosh, man, I should have added these to the presentation. Yes, we did. Colonial Funding Group, the company that started it all, Eddie, for us was the best distressed note buyer, number 1. Number 2, this podcast was the best, and that wasn't just voted by Eddie and I, right? It was voted. Noteinvestor.com put that out there. NoteSchool TV was the best podcast, and then the third one was Note Expo.
Yep, best trade show. Note Industry Award. So we won best distressed note buyer, best podcast. Welcome here. And then best trade show, you've heard us mention Note Expo. So glad to win that. Joe, tell us what this says.
Well, this is the multifamily renter sentiment report, right? So they're saying that 59% of those surveyed said that they're choosing to rent right now. And the other 41% feel that they have to rent due to the high cost of home ownership. So the top 3 reasons people are saying, well, it's high cost, and then enhancing flexibility to relocate, so they choose to rent. But oddly enough, millennials say that they feel like right now that they need to make $139,000 a year in order to afford a home. And then the Gen Zs say they need to make about $137,000 a year. But 74% have said they've pushed off owning a home. Their timeline has lengthened because they can't get into it, right?
Yep.
Just can't get into. Don't feel like they can get into a home right now. But look at this: 71% of baby boomers owned a home, and now there's some of those are choosing to rent as well. So it's just the sentiment as to what's going on in that, and what they feel like they can't enter the home buyer market at this point. So let's talk about commercial real estate values, Eddie. So they're saying Fortune is saying 480 billion wipe out next year. But wait, and that's following a $590 billion loss in 2023. So when you look at that, the Capital Economics, who Fortune was working with on this, says the commercial market is worth more than $5 trillion. So that's a lot of money.
Yeah. So the next bullet, and Joe, I want to tell you something. You slid that slide in there. I've never seen that before.
Yeah.
Right. So, but I mean, the data just is screaming it. Like, I mean, now wait a minute, Joe. On Facebook, the promoter of multifamily, that's not what he said. Yeah.
I'm just saying, look at that. Apartment values will fall next year and provide a negative total return on investment before recovering somewhat in 2025. Look at this. Vacancies are expected 6.6% up next year, up from 5.9 this year.
And a million
downward pressure.
Construction.
Yeah. And look at this. Capital values down 8.8% this year and another 10.3 next year. Well, that's pretty darn close to 20%, isn't it?
Yeah.
So there you go. I mean, Fortune's a pretty big company, and so is Capital Economics. So let's talk about this, Eddie.
Yeah. So I wrote a little funny text to Joe.
Yes.
Right. And this is all made up. So just have this little humor, right? It's probably not humorous to Lennar, okay?
No.
But it was our little internal humor. The guy in charge of the multifamily portfolio is approached by another executive at Lennar, and he says, "Why don't we just keep these properties another year to get more increase in value?"
Lift.
Right? So now the same guy that he said that to at the beginning of the year approaches him now, and he says, "Oh, wait a minute. John Burns says multifamily dropped 17% in value this year." He goes, "Yeah, I know, but this is a $4.3 billion sale. And what's 17% of 4 point? Like it's only about $750 million."
That's right. That's right.
So
yeah,
right.
I like this quote by one of the folks there. They're suffering from a shifting set of fundamentals, that the multifamily industry is dealing with a shifting set of fundamentals.
Yeah. They're saying a 14% drop on this book of business. 14% of 4.5 billion. Joe, call that not calling the ball correctly.
Yeah.
And Joe, they could have just called us.
Yeah, they could have. Yeah.
But they're big boys. I'm not being disrespectful. I think they missed it.
I think they missed it.
I think a lot of people missed it. But like they're big boys. I'll tell you what they're going to do. They're going to put these properties on the market and they're not going to sell them.
Right. Nobody's going to jump in. And
that's what the experts are telling me. I had a very significant conversation with a very high level commercial lender, particularly in the multifamily space. And what he said was they're going to test the market and they're not going to like what the market's going to tell them. He says, I can almost guarantee you they'll pull back.
Well, they will make a deal. It says right here, the company is willing to sell in smaller deals if they need to. What about the home flipping trends, Eddie? So we're talking about investors. So this is the green line is the single family and condos. And then this is the home flipping rate in the blue there is a percentage of home sales. So it was, it was kind of up, but man, it's kind of dropped down there.
Show that blue line up and down, Joe.
Yeah,
not the green, the blue, not
the blue. Here we are, right?
Yeah. And go down like that. That just shows us where we were, though. But you can see just that last little spot. It shows us 2022 through now,
right?
And the reality is house flippers had a unique advantage when people didn't want people walking through their house.
Right.
House flippers do not have an advantage when there's a shortage of houses and the realtors can fill the gap. The only reason people call a house flipper is when they don't want to fool with a realtor.
Yeah.
Right. They don't want to list it. They don't want to do the repairs. They don't want to stage it. They don't want to do whatever. They don't want people walking through their house. But right now, it's not a shocker that the house flipping business this is why you have to go be more than just a house flipper. You got to go, if you're going to be a real estate investor and buy distressed assets, you got to do some more things to make up for where the gaps are. So,
and by the way, Eddie, you look at this line here, that was 12 of 22 when it was up here, and now we're here. So, and this is 12 of 23. So, yeah.
Pretty dramatic drop in a year. Okay.
Pretty dramatic. All right, so let's talk about non-performing loans, Eddie. So 1 in 4,300 homes are at a risk of foreclosure. Default notices, scheduled auctions, bank repossessions are up 5% from a year ago. And these are the 5 top states, right?
Guys, let me just tell you this. There's essentially two categories where we're going to see defaulted loans. One of them are the regular interest-bearing mortgages that predominantly got delinquent during the virus and they're the ones that didn't get modified. They're the ones that didn't recover, right? They were hospitalized loans that never made it out of the hospital. There's basically, Joe, there are 2 million of those loans, kind of rough numbers.
Yeah, we'll show you a chart. The next chart will show that. Yep.
And then the other area are what Joe just wrote on the. He still writes in yellow. I tell him that yellow is not the right color, but
I know.
All right, the HECMs. These are home equity conversion mortgages. I had to think about that for a minute, Joe.
Right.
Because the general public doesn't call them HECMs. They call them reverse mortgages. Joe, this industry went 2 years without being able to foreclose on this inventory, and they've tried to resolve it. And there is a group of HECM loans hitting the foreclosure market now at a rate like we've not seen probably since the beginning of reverse mortgages. And that's because they went 2 years and couldn't foreclose. And these are people that where mom and daddy have died.
That's it.
They couldn't foreclose. That got the loan have now they're not with us anymore. So we're not foreclosing on some old couple's house. That's not what this is. But those two convergents are producing an inventory level in non-performing loans at a rate like we've not seen in a long time.
Yeah.
All right.
And we're on top of that, sir.
We're watching.
Okay. So ICE is the old Black Knight. Okay.
Yep.
Don't ask me what ICE stands for. I can't remember. So Eddie, here's what we're seeing here. Total delinquencies is
just focus on the 90 plus.
Yeah. Yeah.
Because 90 plus is that blue line right there, and it's on the rise. It's not on the decline.
Yep, for sure. So we'll look at this again here. So this is the current cumulative loan to value of loans that are 90 days plus in foreclosure. So the light blue here is less than 80%. This black portion here is 80 to 89%. 90 to 99% is this. And that's a pretty good chunk there in the 100% plus that are underwater.
But this is a reflection of why we say that the defaulted mortgages today are predominantly equitable loans.
Yep.
They're the loans that are in default today. You look at that far chart. It's the light blue, the below 90%.
Mm-hmm.
Right? While it's not quite as good as it was 2 years ago, most of these loans are equitable loans. And I generally say there's 75% that are equitable. And if you look at that line, that's about 75%.
That's it.
So understand that this is tracking with, this chart reflects exactly what we're seeing in real life.
That's right.
Okay.
So I pull these again this month. These are from ICE as well, Black Knight. So this is the active number of active single family mortgages out there. So Eddie, when we go over here, there's that number. Total non-current is 1,962,924, pretty darn close to 1.963 million. And the average delinquency. Talk about that and that.
Yeah. So the average delinquency is about a year, 353 days. Those are loans that are 90 plus days delinquent. Loans that have now moved into the foreclosure category are excessively delinquent. They're over 1,000 days delinquent. Right. But what's going to happen, Joe, I believe, is that a lot of these lenders that have these loans that are not necessarily 3 years delinquent, they've got to go move the dial and move them down the foreclosure pipe.
They do.
Because they've been trying to modify them. They've been trying to do other things. And these loans that aren't paying cause the people, the banks that own these loans, excessive cost.
Yep. And
they just can't go run. The theory was they're going to wait until the election. Joe, they can't wait that long.
They can't wait that long.
They're drowning. And that's why you see banks exiting the mortgage origination space. And it's why you see all of the things that you're seeing where this mortgage servicer or this lender, like, they file bankruptcy or they exited the market or now they're for sale. And it's like, listen, they're pressed up against the wall, and this is what is going to cause, as I told you a while ago, 2024 is going to be the year that we're going to see this snap. We're already seeing it.
Yeah.
We're seeing it at a level that you may not be seeing it yet, but that doesn't mean it doesn't exist.
And Eddie, one of the other things we're going to keep and this is the last slide, the one of the other things that we're going to keep an eye on, and companies like, well, Goldman Sachs and JP Morgan and companies like that, is they're starting to build up some capital to jump on the commercial non-performing.
Yeah, there's no doubt. But there's going to, anytime that there's that level of opportunity, it's going to be opportunities for all of us.
Yeah, absolutely.
And we have been 80% discounted performing mortgages and 20% non-performing this year.
Right.
We have been, there's markets in 2015, we were about 50-50, right? I believe, Joe, that we will look back into exactly where we are a year from now. And I think we are going to be 60-40 performing, 60% performing notes, 40% non-performing. So we've got a lot of growth, we believe, in the non-performing space for all the above. So, Joe, you said it all, right? Yep. We are entered into a new year, and I can tell you, I really am amped up about the opportunities in this business. Some people's business isn't near as good as it was, but all of us know, Joe, that while other businesses are struggling, other people with unique knowledge, this is when you thrive. Mm-hmm. And so we've entered in that space. If you haven't been in the water with us, jump on in. The water's going to be fine. Yeah. And we are looking at a huge opportunity. A lot of people coming to this space because the traditional rentals and apartments aren't working. And what they're finding out is they're pleasantly surprised as to what they can do.
That's it.
Happy New Year.
Happy New Year for sure. Eddie, you it's been a great year. Thanks for all you've done and for these shows, and thank you to all of you who voted for us as being the best podcast. I think we are, so we would both agree with that. We look forward to seeing all of you next year. We'll be back, same place, same time on January 3rd, right? In a week, and a little over a week. So yeah, for sure.
Enjoy your new year. We'll see you next week.
See you guys.
Bye-bye.